Evening, guys. Thanks for joining us. This evening's presentation is all about pensions, and the world of pensions can be very confusing, and you can get lots of different advice from lots of different areas. So what we're trying to do this evening is really just make you able to make smarter decisions when it comes to your pensions. And so we'll just get into it, guys. We're planning to go for about 40 minutes. Kevin is going to take us through the presentation. We're going to have a little discussion after it, more of a sort of a podcast, and where questions have been asked and general questions that we get all the time around pensions. So we'll go through a lot of these. If at any stage, guys, you have questions, put up your hand. We can unmute you. You can ask your question. You can also put your question in the text, and we will get to your questions. Hopefully, we'll have most of them covered. But if there is some that you do have, we're happy to answer them. After the presentation, if you want to send us an email, I'll be more than happy to come back to you with the answers to your questions. So the running hour is I'm going to host a meeting. Kevin is our pension expert, and I'll introduce you a little bit about Kevin in a second. So who are we? So if you don't know who Advice First are, I've been advising on pensions and a wide range of financial services since 1992. I became a very bad employee in about 2004, and I decided that the only person that could possibly put up with me would be me. So I decided I opened my own company called Advice First in 2005, and the name Advice First is exactly what we still do. We want to give advice first and help people understand financials in a simple and open and honest way. So we provide advice on a wide range of financial services, and obviously we're regulated by the appropriate bodies as well. A little bit about Kevin. Kevin has been around pensions. Kevin, I know you didn't like me to say this, but you've been in and around pensions for about 36 years. You started off in 1998 as a pension admin. Spent a good bit of time with FBD and Standard Life, and you've moved into Irish Life but just over 18 years ago. And Kevin is a business development manager with Irish Life, and the reason I've chosen Irish Life is Irish Life would be one of the biggest pension providers in Ireland. They're the people that look after the most people planning for retirement and actually in retirement. So I felt if I was going to get somebody to talk about pensions, then we might as well get the best that we possibly can. And as I say, Kevin has a lot of experience. He's been around this industry for a long time, and I don't think there's a question that any of us can ask that Kevin can't answer. And I rely quite a lot on Kevin. If I get a technical question from a tricky case or an abnormal pension question, Kevin would be one of the resources that I would use to sort of help get the right advice for our clients. So Kevin's going to take us through a presentation, guys. Any questions or queries as we go, by all means, let us know you're there. Let us know what your question is. We will have questions and answers when Kevin's finished. So Kevin, I am going to stop share and I'll leave it up to you.
Thank you very much, Pascal, and welcome everyone. Thanks a million for joining us on this second day of July. Hard to believe we're in the second half of the year already. I really don't know where the time goes. So look, I'm delighted to have this opportunity to talk for half an hour or so about the benefits of private pensions. As Pascal mentioned, I'm nearly 37 years in the industry, which I find very difficult to believe. I actually started, small little typo on one of the slides there, it was 1988 and not 98 that I started. Not at all, Pascal, not at all. But up in my head, 1988 still seems really recent. What can you do? But look, I love this industry, and the main reason I love it is that I see the difference that it makes to people's lives, not just at the point of retirement, but also at other important milestones during one's life as well. Now, most people find it really difficult to believe that the taxman is willing to make a very generous contribution towards your financial independence. But believe it or believe it not, that's exactly what's available and what's up for grabs within the Irish pension system, if you plan it properly and if you avail of the package of tax benefits that are available to people. Now, what I like most of all about the pensions industry and private pensions is when you come close to, or when you arrive at that day where suddenly, if you don't feel like working anymore, you don't have to. because you have enough in your pension to get by. Now, if you're to ever arrive at that day, you've got to put a lot of thought, a lot of planning, and obviously the affordability has to be there as well. So we'll delve into some of these areas now during my slides. I felt if we were presenting on pensions this evening, we could not mention the something called auto enrollment, which is now seems to be pretty imminent. You may or may not have heard about it, but essentially the Irish government are now going to include the vast majority of employees who are not currently in an occupational pension scheme or a PRSA. So this is a massive development in the Irish pensions landscape. Would you believe 800,000 people are expected to be auto-enrolled? Now, initially it's going to be a mandatory situation for the employees who are eligible to go into auto-enrollment. But there will be opportunities for people to opt out in 6 months' time if they want to do that, or 6 months from whenever it commences. So the current target date for the implementation of auto-enrollment is the 1st of January 2025. But a lot of industry experts really believe that that's probably overly ambitious. The way it will work is it'll be phased in over 10 years, with contributions initially being just 1.5% from the employee, 1.5% from the employer, and 0.5% government bonus. It will eventually build to a 6% of earnings member contribution, 6% employer contribution, and a 2% government bonus. There won't be any tax relief. They've decided to go down or to use a model very similar to the old SSIA schemes, if you remember that saving scheme that was introduced by Charlie McCreevy, a number of years ago. So look, I just wanted to, as a matter of good presenting, to include something about auto enrollment because it is such a significant event in the Irish development of the Irish pension system.
Kevin, there's a lot that we don't know about the auto enrollment as well yet.
There is.
They're asking us questions that nobody seems to have any notion about yet.
I would agree with that, but having said that, the bill has been published, so that means they're very serious about introducing this, and it's pretty imminent. Now, even if there's a general election, Pascal, and a lot of people say, oh, if there's a general election, this will be kicked to touch and it might never happen. But it's very important to understand that this has all party support. So regardless of the formation of the next government, it's still very likely that this is going to be implemented, So we did get a lot of information and detail from the bill, but they've also promised more information between now and the end of the year. So we would expect a lot more detail to emerge as time goes on. So that aside, just to reflect a little bit on how the Irish pension system works and how you can make it work for you. Why do we say that funding a private pension is a very good idea? And it is a very good idea. And are we really clear on the features and tangible benefits of a private pension? Because, of course, most people find the topic of pensions really boring. We don't. I find it a very exciting prospect to, as I say, arrive at that day where you no longer have to work anymore if you don't feel like working. So that for me is a very exciting prospect. Now, that's not to say that I don't like my job. As I said, I love my job, but just to have that option is very, very appealing. So I was looking at the possible sources of income that somebody could have in retirement. And I think everything is covered in this slide as regards the possible sources of income after you retire. So the first one would be the state contributory old age pension. That's currently payable at a rate of 14,400 per annum. It's a very good basic pension. It's about 34% of the average industrial wage, but you must, of course, satisfy conditions to qualify for that. And the conditions are essentially that you've paid PRSI most or all of your working lifetime. So that's a great start. One of the big drawbacks of the old age pension, as good as it is, as I say, is that it does not kick in until age 66. The state doesn't recognize early retirement in any way, shape, or form. And another drawback of that pension is that it doesn't provide any lump sum. So, in terms of providing maybe much needed liquidity at the time you retire, you're not going to get that liquidity from the state. It will just be a regular income in effect. The next possible source of income would be from private assets, savings, and investments. This might be money you have in the bank. It
Kevin,
might be
can I just interrupt there? We just
Of
got
course you
somebody,
can, Pascal.
somebody saying the slides aren't moving along with you there.
Well, I'm only on the second one.
Yeah, but
sorry, the third one.
They're not moving at all. They're not seem to be going at all.
I don't know why that is, Pascal. Are they moving for you, Pascal?
No,
no.
Kevin. No.
Oh no. Okay.
Guys, give us a couple of seconds. We'll just fix this up.
Yeah.
Kevin, what you might do is just maybe stop sharing. I'll pull it back into my presentation, and maybe we'll run that way. Would that?
Yeah, no problem. Yeah.
That might be better. Kevin, do you have hosting there now? You should be able to operate this, can you?
Oh, should I? Okay. Afraid not, Pascal. No. If you might as well move them on for me, Pascal, if that's okay.
Should I? Yeah, go ahead, Kevin.
Can you move on to the Irish pension system, possible sources of income? There we go.
Yep.
Okay, hopefully everyone can see that.
Thanks, Annette.
So I was just saying that every possible retirement income, I think, is covered by this slide. So on the left-hand side, we've got the contributory old age pension from the state. We've got private asset savings and investments. That could be money in the bank. It could be a savings policy. It could be money in the post office. It could be a property that you have a rental income from. And my comment about, private asset savings and investments is that they are mainly done and they're mainly purchased from after-tax money. Whereas with private pension funding, it's done with before-tax money. So that's a crucial differentiator between personal investments and pension investments. Then the third category is the one where we're all about, myself and Pascal here, occupational pensions, PRSAs and personal pensions, and with that auto-enrollment possibly coming in 2025, or possibly coming at a later date than that. And the key point about private pensions is that they're accompanied by a package of tax benefits. So there is far more to pensions than just tax relief on the contributions. There are other tax benefits that are just as valuable. And then finally, we've got part-time and full-time employment. Now, very often that's done out of necessity. The exception would be if you're involved in a passion project that you really have maybe harbored ambitions in getting involved in all your life, and you get the opportunity to do that. But a lot of other people, they're short of income in retirement, and they don't have an option other than to keep working either on a part-time or full-time basis. And the beauty of that, the private pension and maybe the occupational pension, is that it should rescue you from that kind of an outcome in retirement, hopefully. So just to move on to the next slide there, Pascal, please.
Roll it there, Roisin. Is that what you're telling me?
Okay, so the tangible benefits of private pensions, Pascal. So for me, okay, the obvious ones are that they provide financial security. They provide peace of mind, especially when you're approaching retirement. Pascal mentioned that I've been around this industry for nigh on 37 years. And I can tell you, folks, when you get to my age now, I'm 56 tomorrow as it happens, pensions become more important than they ever were before. And I know, look, when you're in your 20s and your 30s, it's difficult to envisage a day where you're going to be in your mid to late 50s. Believe me, folks, it doesn't be long coming around. Pensions also, they put your, to use an expression, your tax dollars to work for you while you're funding it, because of course you get and you're entitled to tax relief on your pension contributions. And it's not just tax relief, there's a package of tax incentives available, which I will get into in a few minutes. Now, for me, one of the beauties of private pensions is that they provide you with options that otherwise you would not have. And these options, for example, they might be early retirement options. Maybe you've been working as an employee for a very long time, but you have ambitions to set up your own business. Maybe you just want out of the rat race. And if you have a sizable pension fund behind you or that you've built up, it's a lot easier to make those crucial decisions than what it would be if you didn't have a pension fund behind you. Now, private pensions can also bridge the gap between the state pension age, which, as I mentioned, is 66. So if you want an income sooner than that, you're not going to get it from the state. A private pension can work very well there in maybe getting you from age 60 to 66, and then the state pension kicks in. Crucially, the private pension provides you with a very valuable tax-free cash lump sum and tax-efficient lump sums as well. Now, furthermore, a private pension can provide a very tax-efficient inheritance for your spouse or family if you die prematurely. And, you know, God forbid, if you don't make it to retirement, the pension funding is never wasted. It's either going to benefit you or it's going to benefit your dependents. So funding a pension is never a waste of time, even if you don't make it to retirement. And then at the point of retirement, you know, your private pension fund, it can provide you with a holiday, a change of car, a deposit for a house. It can pay down debt for you. And it gives you, it gives an opportunity to put the tax concessions. Again, I emphasize that there are various tax concessions available to retirees that they're largely not appreciated that they are there, but they will assist you in minimizing the tax you pay on your pension when it kicks in. So if you just look at that slide alone, for me, they're the tangible benefits of having that private pension, and none of those would exist without that private pension in the background. Just move on there, Pascal. Thank you very much. So look, over the years, I've always been very interested in the subject of financial independence. I think it's a very worthy goal and a very worthy ambition if affordability allows it. And some of the tips that I personally picked up over the years from various speakers, could have been Anthony Robbins, could have been Brian Tracy, different motivational speakers down through the years. I've tried to implement these for myself, and I have to say they have stood me in very good stead over the years. So one of the first tips that I learned in my 20s was that when you begin earning money, it's a very good idea to pay yourself first before you pay anybody else, creditors or bills or anything like that. You might even call that account a financial freedom account. Okay, so you look at paying yourself first, and then once that's taken care of, you use the balance of your salary or wages to pay for everything else. Now, in paying yourself first, if you can find a way to do that whilst legally avoiding paying income tax on what you're paying yourself, you know, you're well on your way to financial independence. And then thirdly, if you can invest that money that you're paying yourself in a fund that has a favorable tax treatment, because you don't want to be losing half of it or a third of it to the state. And that's a very easy thing to do because most investments are taxable and they're taxable at a relatively high rate. You then employ the principle of delayed gratification and have long time perspective. And you employ the discipline never to access that fund. Now, obviously, this would be in conjunction, I'm sure Pascal has spoken about this himself, this would also be in conjunction with having an emergency fund for some of the short-term liabilities and emergencies that might arise. You get to employ the power of compound interest on that money over time. And if you examine ways to minimize your living expenses and then redirect that to something like a pension, you get an immediate uplift of either 40% or 20% because of that very valuable tax relief applying. So for me, those 7 principles of wealth building, they marry very, very well with the Irish pension system, as you will see on the next slide. So if you look at those 7 principles in the context of the Irish pension system, with the pension, you get to pay yourself first. So it might be an AVC, it might be a member contribution. Not only do you get to pay yourself, but you get to avoid paying income tax on it. There is no benefit in kind on that money. You get to invest it in a fully tax-exempt fund, and the compounded effect of a tax-exempt fund over time cannot be overstated. You get to employ delayed gratification and long time perspective, because you actually don't have an option on that, and you can't be tempted to access your money early, because in most cases you're not allowed to do that because it's a private pension. You get the benefit of the miracle of compound interest working in your favor, and that's the tax-free version of it, because in the accumulation phase of a pension, all the returns within the fund accumulate completely tax-free. And any savings in living expenses that are redirected to that financial freedom fund, otherwise known as a pension fund, will benefit from that income tax uplift as you benefit from the tax relief on those contributions. So a lot of people don't realize, or they don't look at it this way, and I think it's a very interesting way to look at a salary. So if you have a salary or a wage, that salary actually produces not one income, but it produces 2 incomes. It produces income tax for the exchequer. You very often cannot avoid that unless you claim income tax relief on what you're entitled to claim it on. And then the net after-tax income is for yourself. So every salary that's subject to income tax generates 2 incomes. And what a private pension actually allows you to do is to tap both sets of income from the one salary. Now, I think that's a fascinating way to look at a salary. It's producing 2 separate incomes, and the only way to benefit from both is to fund a private pension. If you don't fund a private pension, then what goes into the exchequer stays with the exchequer, and you never see it again. So it's a very interesting and accurate way to look at any given salary. Now, in terms of the value for money that private pensions can provide, this slide actually arises from a conversation that I had with a cousin of mine some years back. My cousin had joined a new company. She had secured quite a high-level job on quite a high salary at the time. And of course, me being me, in the conversation I was having with my cousin, I was inquiring about what are the pension benefits like with your new company. To my astonishment, she informed me that she had opted out of the pension. She didn't really have interest in pensions, and she didn't want the additional expense of the pension contribution. So as you can imagine, I was horrified to hear that.
Did you disown her at all, though?
Well, I showed her this, and I was successful in changing her mind. Now, this pension was it wasn't an off the scale generous contribution rate, but it was a good contribution rate. So the company were going to contribute 10% for her. We'll say, for the purposes of the slide, that the salary was 60 grand. She would be paying 5%. So that's a total contribution of 15. Her contribution of 3,000 euros would only cost 1,200 because of the 40%, the 40% tax relief worked out at 1,200. So the net cost to my cousin was 1,800. Now, here's the key point, guys, with that kind of a defined contribution structure. For a cost of 1,800, the member was benefiting from a total investment of 9,000 euros into the pension. To put it another way, before the money was even invested, that represented a 500% return on the net cost to the member. So when you examine the net cost of pensions in company pensions versus the full amount you're benefiting from, it can be extraordinary, a little bit like that slide that you're looking at the moment. So, and then, of course, when you get into the investment markets, all your returns are tax-free as well. So a very interesting slide for a cost of what. Can you imagine if there was any other product like this where somebody was calling to your company and saying, for every 1,800 you invest, you'll get 9 grand. I think Pascal and I would have queue out the door for any kind of a structure like that, but it is available to an awful lot of people under the Irish pension system.
You good to go, Kevin?
Yep. Okay, so I mentioned the tax benefits, and I mentioned that tax relief was not the only benefit of a private pension, albeit that the tax relief is very, very valuable. So the way I see it is that there's actually 5 tax benefits that apply to a private pension. You've got your tax relief. We've just seen the value of that on the previous slide, either 20% or 40%. Sometimes the relief will straddle the 2 tax brackets, depending on what your income is. Just to mention as well that all employer contributions to PRSAs are actually unlimited. Employers can contribute anything for a director at the moment, except to be aware that there is a pension fund cap of 2 million, which doesn't affect too many people. You've heard me mention the tax-free growth on the fund. Again, the compounded effect of that is enormous over the long term. Then you come up to retirement and to claim your benefits. You can get a portion of your pension fund completely tax-free. Now, the tax-free amount these days is capped at 200,000. And because most people opt for the 25% of the fund value as the lump sum, that means in order to get the full benefit of the 200,000 tax-free, you would need your overall pension fund to be worth 800,000. Now, 3/4 of your pension fund then is taxable on drawdown. But you can invest in something called an approved retirement fund, or a vested PRSA. There's no need to get hung up on the technical names of the products. But the point is that you can employ some very valuable tax planning, because you're only taxed on what you decide to draw down, albeit that you have to draw down a minimum amount. Now, the minimum amount you must draw down is 4% between 60 and 70 and 5% from 70 on, and you're taxed on that. You don't have to draw down anymore. You can if you like, but you'd want to be keeping an eye on the tax position. Now, I will, in a couple of minutes, I will look at a couple of very quick tax calculations to show how tax efficient a pension can be, even at the drawdown stage, and even acknowledging that the drawdown is fully taxable. And then finally, tax-free death benefits. Again, look, a certain percentage of the people won't make it to retirement, and if you don't, I mentioned earlier that the pension isn't wasted. It now becomes a benefit for your next of kin. And with many pension products, the full value can be paid to your estate. No capital acquisitions tax might apply depending on the beneficiary, but there is no capital acquisitions tax between spouses and civil partners. So there's your package of 5 tax benefits that you cannot get in any other kind of a financial product except an Irish pension product. So just moving on there, please, Pascal. So one of my little mantras that a lot of people like Pascal would hear me talk about is why people, if the affordability is there, acknowledging that it's not always there, of course, but that if you can afford to target a fund, a minimum fund of 400,000, there's an awful lot of reasons why that is a superb idea. Now, I'm saying that in the knowledge that the average maturing pension fund in Ireland is not much more than 150,000 euros. So 150,000 euros is a good pension fund, but it's not realistically going to sustain you in retirement for very long. So with a target fund of 400,000, you would end up getting 100,000 of that as a tax-free cash lump sum into your hand, which you can do what you like with: a holiday, change of car, pay down debt, whatever. Then with the balance, the 300,000, you'd have to draw down 4% of that minimum from, say, an ARF, that stands for Approved Retirement Fund. And then when it comes to your income tax, once you pass 65 in Ireland, you get an option on how to calculate your income tax. So I'm going to stick with that fund for the next couple of slides, because I think it's really interesting how the income from that kind of a fund would be taxed, even in conjunction with the state pensions, and how low the effective income tax rate can be on it. So yeah, so the next slide here is saying, you get a bit of a birthday cake here from the taxman of all people, because not a lot of people realize that in Ireland, when you come to your 65th birthday, for the first time in your life, you actually get an option as to how to calculate your income tax liability. And whichever of the two options produces the lowest liability is the one you're allowed to opt for. So the first one is the tax credit system. That's the one we all have to use up until we're 65. But then the second option, if you're married and over 65, you can earn up to 36,000 completely tax-free. And then if you choose this system and your income is more than 36,000, you pay 40% income tax on your income above 36,000. Now, there's a bit of universal social charge to pay as well, but that won't break the bank, as the note says there at the end of the screen. Now, income tax calculations, even though there's a perception that income tax is complicated, it's actually ridiculously simple, as I hope to show you here in a couple of minutes. So again, sticking with that 400,000 fund, we'll move to the next slide. Okay, so here's the breakdown of that. I've kind of covered it already, but just to put it in the form of a graph there as per the screen, your private pension matures at 400,000. You're married and you're over 65. 100,000 of tax-free cash, perfect. 300,000 then is available to go into your post-retirement product. As you'll see at the end of the slide there, that should produce an income in the first year of about 12,000 euros. And the next question might be, what tax will I pay on that 12,000 of personal income? And of course, the answer to the question, how much tax do I pay, is that, well, it depends on what your overall income is. You can never isolate one income and calculate your income tax liability on it. You have to look at the holistic picture, as I think we have on the next slide. Yeah, so here we are. Here's our 12,000 euros of income, which emanated from the 400,000 private pension. Remember, we've already banked 100 grand, and there's no further tax on that if you put it in your bank account, and it generates a bit of interest. There'll be a bit of dirt tax on that, but other than that, there'll be no tax on the 100 grand itself. I've then assumed that you're going to qualify for the maximum rate of old age pension, which is currently 14,400. I'm also assuming that you'll be claiming the married rate of old age pension, which is another 12,900 if you qualify for that. And then just for pig iron, I've thrown in an additional income of 5,600, just so that our total retirement income for this couple is 45,000 euros. Now, remember a minute ago, I said you get an option at 65 as to how to calculate your income tax liability. You can go with the tax credit system, or you can go with the lower exemption limit system. Both calculations are ridiculously simple, as I hope to show you on the next slide. Okay, so here are our two income tax calculations on a joint income of 45,000, albeit that it's coming via just one spouse. Okay, so lower exemption limit calculation is that the 36,000 is fully exempt. And then you've gone over the 36,000 to the tune of 9,000. So you pay 40% of that, and that becomes your tax liability, 3,600. Now, when we express that tax liability as a percentage of the 45,000, it's 8%. But we don't know if that's the best deal for you or not, because we have to look at the tax credit calculation on the right-hand side. So the way that will work is that you'll pay 20% of 45,000 because that's all in the standard rate tax bracket. So that's a liability of 9,000. We'll then deduct all your tax credits that you're entitled to claim, and your liability falls to 3,130, or in other words, a liability of less than 7% of the 45,000. So that's a better deal than the lower exemption limit. So again, this all started with the 400,000 fund. We banked 100 grand of it. Now we're now drawing an income from the balance. And when we add that to all our other incomes, we have 45 grand of income, and our income tax liability is less than 7%. So that's a pretty good deal, no matter what way you look at it. So just moving on. Okay, just a couple of words on additional voluntary contributions. If you're in a position to make AVCs, that means by definition, you are in an occupational pension scheme, because only members of an occupational pension scheme can make AVCs. So you have income tax relief available to you. There are age-related limits that range from 15% to 40% of your earnings. So that will dictate how much you can claim against tax relief, and you must also include in that any contributions you're making to the main scheme. So any AVCs you make will be used to increase your pension benefits. If your main scheme is a defined contribution scheme and you ultimately take a lump sum of 25% of the value of the main scheme, you can also opt for 25% of your AVC fund as an additional lump sum. And as long as the combination of the two are less than 200,000, all of that lump sum will be tax-free, and the balance then will be available to be invested in a post-retirement product, and you can draw your income from that. The income is taxable, but as we've just seen in the majority of cases, the income tax liability is far less than people appreciate. Okay, so just in terms of the tax relief on pensions, we only have two tax rates in this country. There's a 20% rate and there's a 40% rate. But in terms of expressing that tax relief as a return on your money, a 20% tax relief is exactly the same as getting a 25% return on your money. So to put that another way, if you invested 80 euros, for that 80 euros to grow to 100, you would need a return of 25%. If you're a 40% taxpayer, and if you're entitled to 40% tax relief on your pension contributions, that is the equivalent of a return on your money before you ever enter the investment markets of almost 67%. So in other words, if you invested 60 euros, for that 60 euros to grow to 100 euros, your return would need to be 67%. Now, can you imagine if any bank had a product where they were saying, if you save with us today, we'll give you a return up front of 25% or of 67%, the demand that would be there for that. But those returns are there for people within a pension structure if you're comfortable knowing that you won't have access to that money until you retire. And again, in the context of that emergency fund, which I'm sure Pascal has mentioned in the past, an emergency fund is vital for the short-term liabilities and the short-term that emergencies that crop up for all of us on a regular basis. So just moving on. Okay, so to finish up, this is I think the second last slide or thereabouts, just a really good example of somebody on the standard rate of tax who's single and who wants to plan a pension on a pension fund where they will not end up paying higher rate tax on their pension. So just to move on to, I think this is coming up line by line, Pascal, so you might just bring it up line by line. So if we look at a single client who's over the age of 66 in 2024, the standard rate cutoff point is 42,000. So anybody who's single can earn up to 42,000 without paying 40% income tax. Now, we also know that assuming this client is entitled to the maximum contributory old age pension, that will be an amount of 14,400. So they now have an income gap in respect of that standard rate tax bracket, and the income gap becomes the tax bracket itself minus the old age pension. So in other words, this individual could afford to have another retirement income of 27.5 grand, and they would never pay higher rate tax on it. So the post-retirement investment required to generate the income of 27,000 is 689,525. But that's the post-retirement investment. The pension fund itself required to generate that investment because, of course, 25% of it can be taken in lump sum format. The pension fund required to get that individual to that income would be 919,000. Guys, we're not off the million mark at this stage for this particular individual. So, you know, it's hard to believe you can have a pension fund of over 900 grand. And as per this slide, you'll see that the guy is not going to pay a higher rate tax on it. So the total retirement income, now if these assumptions are borne out, will be the contributory old age pension, the 27 grand from the post-retirement product, giving exactly what we want, 42,000, because that's the standard rate of tax. So the tax liability on that would be calculated as 20% of 42,000, which is 8,400. We take off all the tax credits. That reduces the liability to 3,995. The tax credits themselves are 3,995, and that reduces the liability to 4,405 on an overall income of 42%. Which means that the effective income tax rate when we apply it to the full 42,000 is 10.5%, even though the guy had a pension of over 900 grand to begin with. And look at the lump sum from this pension on the next line. Yeah, the gross retirement lump sum, because it's a quarter of the 919, is over 200,000. Now, because it exceeds the 200,000 cap, there's a bit of tax on it, but it's not too onerous or too penal. It's just 20% of the excess. So the net lump sum that this guy will get into his hand is 223,872. He'll invest the balance, draw an income, and end up paying 10.5% on it. So where would you get that in fairness, except from a private pension, if it's planned out properly and if these little facts and little income tax calculations are understood? It's all there waiting to be done. So in summary, guys, just to recap, as I finish up, I would say, look, if you can, take a fresh look at pensions as a superb wealth building opportunity over time. Now, I'm not saying there's not downside to pensions. The biggest downside is that you're not allowed to access the money in emergencies, and you've got to come to terms with the fact that it's there for the long term and from your retirement. So many of the tax benefits actually work on a use it or lose it basis. So if you're entitled to claim up to or maybe do an AVC on up to 25% of your income, and you say, oh, I'll do 10%, I'm happy with that. You don't get to carry forward the 15% you don't use. You actually lose it, and you start again next year with 25% again. Don't forget about the compounded effect of the tax relief and the tax-free returns over time. This will make a significant difference to your investment. For obvious reasons, you're not paying any tax on the fund during the accumulation phase, although, as we've seen, pensions are taxable on drawdown. So pensions, they provide you with valuable options at different times of your life, which otherwise would not be available. And again, going back to our tangible benefit slide that we looked at the beginning, you know, if you harbor ambitions as an employee to maybe set up your own business, or just get out of the rat race, so to speak, or set up a self-employed business, or change career, it's just a far easier decision to make if you know you've got a decent private pension fund behind you as a safety net, so to speak. So pensions can offer a buffer against redundancy, against leaving your job or changing career. And I can't overstate that enough. It's a very real, tangible buffer against those unfortunate events. And again, pensions can offer financial security, especially when you get into your 50s, as I've discovered and I'm discovering, and I've never been so happy to have a private pension myself because of everything we discussed so far.
And of course, yours is close to the 999,000 that you were talking about there, Kevin.
No comment, Pascal. I couldn't possibly confirm or deny that.
Guys, I'm just conscious of time here. So, Kevin, with your permission, I'm going to skip on to a few questions, if that's okay.
Sure, absolutely.
Guys, as you can see, the pension world is a big world. It doesn't have to be overly complicated. And what I would say to you is take it one chunk at a time. And the first thing is sit down with a bloody good advisor and figure out, well, listen, what is the plan? Where do you want to be and when do you want to be there? And then everything can work around that. So we'll skip through some of these questions. Kevin would have dealt with a good few of them. Should everybody be paying into a pension? Kevin, I'll handle this one. Guys, if you're 30 and living in your mum's house and you're trying to get a mortgage or you're trying to buy a car and you don't have an emergency fund, or you're a young couple trying to set up home and your biggest challenge is how to get an emergency fund up and how to pay the electricity bill on a weekly basis and how to get the shopping, do not fucking worry about a pension. There's no point worrying about your 65-year-old self if your 30-year-old self is under pressure. Deal with that. Pension is not for everybody. It is at some time in your life, but not for everybody all initially. No. Kevin, skip through these quite quick. If you have 2 jobs, can you have 2 pensions?
Absolutely, you can. Yeah. Yes, okay. Is the short and the long answer to that. If you have 2 incomes, now when I say 2 incomes, obviously those incomes have to be eligible to be pension. So for example, if one of those incomes was a rental income is not deemed to be earned income and it's not pensionable. But if the question is in the context of 2 jobs and 2 salaries, absolutely you can have 2 pensions.
Perfect. What happens if it changed jobs?
If you change jobs, you'll have a number of options around the pension you're leaving, so to speak. You can simply leave it where it is. You can transfer it sometimes to what's called a personal retirement bond or a PRSA, or you can transfer it possibly to your new pension scheme. Now, personally, and this is just a personal choice on my part, I don't think it's often a good idea to transfer a previous pension to your current pension. Now, why am I saying that? Well, it's because if you transfer it to your latest pension, you won't be able to access either until you retire from your latest company. Whereas if you had left it separate or moved it to a personal retirement bond, you would have access to that from the age of 50 without it interfering with your current employment or your current pension.
Again, guys, what Kevin's after saying is very, very important, and he would probably need to say it again, but we don't have time. Again, sit down with your advisor before you make any pension decisions, guys. Is my pension taxable? Kevin already dealt with that. Yes and no. You get a lump sum, the rest of it will be taxed as you draw it out. What happens to my pension if my company, if the company I work for goes bust? Kevin, do you want to handle that one?
Yeah, so one of the beauties of the Irish pension system is that it is set up more or less precisely to cater for that kind of a scenario, because all occupational pension schemes by law must be set up under trust, and the purpose of the trust is to separate the assets of the pension scheme from the assets of the business itself. Hence, if the business gets into trouble and has to be liquidated or struck off or whatever, it doesn't interfere with the pension assets, and the pension assets are fully secure and cannot be accessed by the employer.
Perfect. Can I borrow from my pension scheme? I'll handle this one, guys. Not from your pension scheme. No, you can't. But you can use your pension scheme to borrow to buy property. You can use your pension scheme in certain ways, but it has to be a self-directed or a self-administered pension. Again, you need to take financial advice and tax advice before you'd even look at this, before you'd even bother even taking a look at it. Possible to borrow on the strength of your pension, but you can't borrow from your pension. How are pensions benefits calculated? Kevin, do you want to suppose that there's a very long answer to that, and obviously it depends on the pension you've got, but do you want to throw an answer to that one, Kevin?
Yeah, well, look, these days, in the majority of cases, the pension fund is what's known as a defined contribution scheme. And a defined contribution scheme it's really simple. That just means you have a fund of money available to you, and typically the most common options that are taken from that is that 25% of the fund value is taken as a lump sum, as we've said several times, and then the balance can be invested into a post-retirement product. Now, the person who asked that question may be asking it in the context of a defined benefit scheme. A defined benefit scheme is where your benefits are typically calculated based on your service and your salary. Now, a very common defined benefit structure in the public sector, you would typically get 1/80th of your salary for each year of service, and you'd get a lump sum of 3/80ths of your salary for each year of service. In the private sector, the typical defined benefit structure would tend to be 1/60th of your salary for each year of service.
Getting very complicated now, Kevin.
Yes. But
you're going way down a rabbit hole here at the minute. So.
it's difficult to avoid rabbit holes in pensions.
Guys, it comes back to the same thing. Sit down with your advisor. There are choices. There are ways that you can do it. Get yourself a good advisor and sit down and get the answers here, because we can't deal with individuals on a presentation like this. When can I start receiving my pension? Anytime after 50 if you're in a company. If you're a PAYE, it will depend on if it's a company scheme, depending on what the company tell you. But pretty much anytime after 50 if you need to, if the company lets you go. Self-employed people.
Just to clarify on that there, Pascal, right? You're absolutely right. You can avail of benefits after 50, but in order to qualify for your benefits in your 50s, you must early retire and you must leave the company where you're working.
Thanks for the clarification, Kevin. Can I have multiple pensions? You kind of answered that. You can, provided you have two sources of income and all of that. Now, there is stipulations that, Kevin, around the max funding of 115k for somebody that's a PAYE and all of that. So they need to max out. If they're in an occupational pension scheme, before you can fund a second pension, you must max out on the original and your main occupation pension scheme. Is that fair to say, Kevin?
Yeah, the occupational pensions. If you're dealing with a combination of an occupational pension and a self-employed income, the salary from the occupational pension scheme uses up the earnings cap first. So if, for example, you are lucky enough to be on 100 grand salary, that uses up 100 grand of the 115, which means on the self-employed side, you're only allowed to pension 15,000 of your income. Again, that's one to sit down with Pascal on if you need more on that.
Is there risks associated with pensions, guys? There are. Kevin and I have dealt with the previous webinar around investment advice. So if anybody wants advice on investments, I'm more than happy to share the link for the previous webinar. It'll take you through the investment side. Pension annuity. This is sort of dovetailing into I see Kevin Kelly has a question there around annuities and that. So question is, what is an annuity? An annuity is that when you get to pension age, you give away your pension amount and you buy a guarantee of income for the rest of your life. And annuities kind of fallen out of favor in recent years with the onset of approved retirement funds. So again, it's a very big decision to be making. It is one that warrants advice. So don't just jump one way or the other. Take advice on it. Kevin, can you see Kevin Kelly's question there?
No, can you call it out to me, Pascal?
Okay, well, 2 seconds. Let me just 20 years paid into a defined benefit pension scheme, now closed with benefits retained, and now in defined contribution pension scheme and making AVCs. If I wish to take 1.5 times salary and take tax-free lump sum, can I use what is defined contribution scheme and still take a NARF for the balance, or do I have to take an annuity?
Yeah, so those kind of schemes are quite common at the moment. They're referred to as hybrid schemes, where you've got a closed defined benefit scheme, and then going forward, you're contributing to a defined contribution scheme. The general rule here with the lump sum, and to answer the specific question, is that if you qualify for the 1.5 times salary and you take it from the defined benefit side of the equation, now to get 1.5 times, you must have a minimum of 20 years service done at normal retirement age. If you take your 1.5 times salary from the defined benefit side, you cannot get another 25% of the defined contribution scheme as another lump sum, but you can fully ARF the defined contribution side. There's no problem with that. Or alternatively, you take no tax-free cash from the defined benefit side, you can get 25% of the defined contribution side and ARF the balance. But I think the question is that if he takes 1.5 times from the defined benefit scheme, can he still ARF the defined contribution? And the answer is yes.
Okay, Kevin, I hope that answers your question. Guys, we're kind of at the end of the session. One thing is we have recorded this session, and all our webinars are available on our website. So there is a link to our YouTube channel on our website. So if there's any of them, if you can't find it, by all means, send me an email. I'm more than happy to send people a copy of the recording and a link to the copy of the recording, but they are all available on our website. So go in and have a look, and by all means, let us know. If you have any questions, guys, because it's very difficult for the likes of Kevin Kelly there to sort of get into the nitty-gritty and into the weeds of their own pension. If there is any specific questions, by all means, give me a shout. And should I have to lean on Kevin, there is no problem there. We can get Kevin to answer any heavy questions and all the big important questions, because he's the brains of the pensions. As you can see, he's very passionate about the pensions, as we all are. But Kevin would be the guy that I would lean on if I just have a wee brain fart all the time and don't have the answer. So generally I do, but just in case I don't. So guys, thank you very much for taking the time to be with us. We have overrun a little bit, but I felt it was important. We covered a good bit of ground. Any questions or queries, guys, come back to us. You're welcome to come and have a chat with us about your pensions. Kevin, as always, thanks for your help. And guys, tune in next month for our next one. Chat soon. Bye-bye.
Thanks, Pascal. Cheers.